Hey everybody, Jack Lucky, Mortgage Advisor here, and welcome to episode 1 of Mortgage Myths. In this series, I'm going to be going over things that I have heard people say in the mortgage industry, whether borrowers, realtors, or fellow loan officers, that are not quite accurate most of the time. So, let's get started. All right, mortgage myth number 1, you can write off mortgage interest on your taxes. This is something I've heard fellow loan officers say most of the time as a reason for buying a house with a mortgage, because you can write off the interest on your taxes. Now, hold up, wait a minute. I know what you're going to say. Yes, you can write off mortgage interest on your taxes. But I'm here to tell you today that probably 80 to 90% of first-time home buyers are not going to do so. Now, let me show you why. Disclaimer, before I get started on this, I do have to say that I am not a tax professional and none of this is to be construed as tax advice. So let's get started. The way you write off mortgage interest on your taxes is through your Schedule A on your tax return, also known as itemized deductions. What this is instead of taking a standard deduction, you can show itemized deductions in certain specific areas, and if the total is more than your standard deduction, you can write those off on your taxes. So let's get into this in detail. The first part of your itemized deductions is medical expenses over 7.5% of your adjusted gross income. So this is not all medical expenses. This is only if the total of your medical expenses for the year is over 7.5% of your annual income. Now, most people have health insurance and deductibles and things like that, and there are very few times where you're actually going to see this used at all unless you have a big medical event one year. God willing, you'll never see that. Secondly, property taxes. You can write off your property taxes. There's also some other taxes that you can lump in there too, but the big majority of it is property taxes for that part of the Schedule A. Thirdly, mortgage interest. This is the one we're interested in. Your interest on your mortgage, your PMI that you pay, and any points that you paid when you first bought the house as well, points on your interest rate. Fourthly, charitable contributions. If you are a generous giver or regular tither at your church, you can write off that on the Schedule A as well, and it counts towards your total. And lastly, there's a little catch-all of other allowable expenses. It's usually little things like unreimbursed job expenses, uniforms, things like that. Or if you paid a tax professional to prepare your taxes for you, that can be lumped in there as well, the cost that you paid them to do that. So that's all of it. And the total of all of those things, in order for you to get any benefit out of this at all, the total needs to be higher than your standard deduction. Now, the standard deductions haven't been announced yet for 2022. They typically go up a little bit to account for inflation every year. But last year in 2021, the standard deduction for a married filing jointly was $25,100. For head of household, which is someone who's not married but does have children, was $18,800. And then for single filers, it was $12,550. So let's run a little scenario, shall we? Sally and Joe are a lovely young couple who just bought their first house last year, and now they're getting ready to file their taxes, and they are excited to see what benefit they got by writing off their mortgage interest on their taxes this year. So they get started with the Schedule A with their tax professional. First section here we get to is medical expenses over 7.5% of their adjusted gross income. This one, they come up with a big old fat 0 because they are pretty healthy, didn't really have any big medical expenses this year. Secondly, property taxes. Now, they do live in St. Charles County, so property taxes are kind of high. And so they're able to put about $3,000 down in this section right here. Secondly, mortgage interest. Here we go. So they are first-time home buyers and they didn't have a lot of money to put as a down payment. So they got a pretty good size mortgage at a fairly decent interest rate, but that got them for the whole year, their total interest was about $7,000 with PMI and everything. So pretty good chunk of change right there. That's going to be a pretty nice deduction, right? Yeah, we'll see. So anyway, moving on, charitable deductions. Joe and Sally are very good tithers. They give full 10% of their income, and they make about the average income of family in St. Charles County, which is about $60,000. So there you go. They gave about $6,000 in charity this year. And they had a couple $100 worth of other expenses, paying the tax preparer and things like that. So there you go. Their grand total for their itemized deductions is $16,200. See where we're going with this? Here we go. So in order for them to get any benefit at all out of this itemized deduction, it needs to be higher than their standard deduction. Now, Sally and Joe are married. Their standard deduction is $25,100. Way more than their itemized deductions. Even if they had a large medical event and had a little bit more medical expenses, it probably still wouldn't get them there. Even if they maybe gave more, maybe they were more generous givers, they would have to get over $25,000 for the total on their on their itemized deduction. Well, let's say maybe you're in a different situation. Maybe you're not married and you just have a couple kids. Then you are filing as head of household. Even then, if you're in this situation, your standard deduction is still going to come out better. The only one that's going to benefit in this scenario is a single filer. If you are a single guy or gal living by yourself, making $60,000 a year, regularly tithing, and living in an average home with an average loan amount and an average interest rate, you would actually be able to benefit from this deduction. So there you have it. So myth number one, you can write off mortgage interest on your taxes. I'm going to grade this as a half truth. It is technically true, you can. However, I would bet about 80% of homeowners in Missouri probably are not writing off their mortgage interest on their taxes. They're probably going with the standard deduction. So that's all I have to say about that one. I hope this has been helpful and beneficial for you guys. Thanks so much. See you next time.